Now, crude has been a big talking point after it spiked up about 5% 2 days ago. Chris Main, the Commodities Strategy Analyst at Citi, joins us on the show to talk about that. Chris, good morning. We've seen a big move in crude in the last couple of days. What are the key reasons for that, and do you expect further upside in the near term?
Well, I think there's potentially a number of near-term factors at work. Partly, even though fundamentals remain bearish in our view, you have seen perhaps what you saw in the second quarter of this year in terms of hot money flows coming in to support the market. In the US market, you've had headlines such as last week's rig count decrease, causing some perhaps shorts to exit the market, although, as we've stated many times previously, the direct link between rig count and US production, it takes time to lead a drop in rig count to a drop in production. So I think it is perhaps a little too early to judge on that basis. And we've also seen in the Brent market some near-term factors supporting refinery demand in Europe has been strong as refiners look to buy after maintenance, while also the pull from Asia, especially China and South Korea, for North Sea cargoes is also providing some help there.
Okay, then let me put it this way. Would you say the worst is over, given that you spoke about the rig count and other factors?
I wouldn't say that the worst is over yet, and that's simply because on a global oil scale we remain oversupplied, and the first quarter of next year we have Iran looming on the market that could bring somewhere between 300,000 to 500,000 barrels a day of crude to the market in a very short space of time. And so even though we have some of these near-term supportive factors that I've just mentioned, if we continue to be oversupplied, right now crude is finding some support, but margins can weaken because product inventories keep on building, and also this addition of that Iranian crude I talked about will continue to weigh on markets. But as you mentioned, the US production, yes, US production is slowing down. It's coming down from its peak of 9.6 million barrels a day. But one thing we need to bear in mind is that on a global scale, shale is about 6 million barrels a day, and global oil supply is about 93 million barrels a day, so about 5 or 6% even. If we look at the other two big sectors, that's OPEC and non-OPEC, non-shale, they account for the rest of global oil production, and OPEC continues to go from strength to strength with Iraq, Saudi, and then Iran, and also non-OPEC, non-shale is showing minimal declines. You just look at the North Sea, West African, Russian crude production, it continues to impress year on year, and outside of Mexico, you're not really seeing material declines in this sector.
Okay. Chris, can you tell us a little more about how much US oil production has declined from shale in particular?
So US crude production reached a peak of about 9.6 million barrels a day in April, I believe, and now it's probably around the 9.2 million barrels a day mark. We expect perhaps another 200 to 250,000 barrels a day of decrease in shale production. That's coming from a further anticipated drop in rig counts. So we see crude production in the US bottoming out about perhaps just slightly under 9 million barrels a day in the first quarter of next year. However, given productivity gains you continue to see, if you maintain the rig count even at a rig count perhaps 50 rigs lower than where it is now, then you can see production flatline in the first half of next year, but then start to increase in the second half of next year. And if we see price rises, as we are now, with WTI flirting near $50 a barrel, that's just going to incentivize producers to lock in hedges for next year where they are under hedged, causing potential for further production.
So that's about production, but what about demand for crude? The EIA said on Tuesday that global oil demand would increase by its fastest rate in 6 years in 2016 because supplies from countries outside OPEC is stalled. Is that your view as well?
So in terms of demand will increase 2016. I think growth is the key part. So this year we see growth around the 1.6 million barrels a day mark, and demand growth really has been quite strong, particularly in the light end, so that's the gasoline and the petrochemical space, but that's driven by a more consumer-led focus. Whereas if we look at the industrial-led complex, the likes of distillate and fuel oil, if you take into account some fuel switching at the beginning of the year due to shipping, while also colder weathers in the US and Europe, now distillate demand looks relatively meager, and going forward with the general macro outlook, in particular in China, and perhaps what it could do for the rest of the emerging markets, the outlook for the distillate space in particular, demand-wise, looks somewhat tempered. So next year we see growth, global oil demand growth declining. I think it will be difficult to reach near 1.6 million barrels a day again, because you're not going to have that same price effect as you have had this year. However, you can see some kind of continuation of the gasoline strength, and this could put demand next year somewhere between 1.2 and 1.3 million barrels a day. Okay. Growth, that is.
Okay. And what are your Brent price estimates for the year end?
So by the end of the year, we expect Brent prices to be trading in the mid-40s, and this is as in pretty much the big driving factor behind this, as we see the potential for crude stock builds in the United States to pull down the US benchmark WTI. So we think heading into the first quarter of next year, you could see WTI trading in the 30s again. Our price estimates are for $39 a barrel, with Brent around $44 a barrel. However, we see 1Q next year, and perhaps mainly 1Q next year, is probably the low point for crude prices, and then you kind of continue on that rebalancing path that you have done. So as we go into the end of 2016 and into 2017, things start to look a lot more in balance, and given where Saudi production is now, you have a much lower level of spare capacity in the world, and so exiting 2016, you could see Brent prices around the $60 a barrel mark.
Okay. You know, there were reports suggesting that Russia may work with the OPEC, and there is increasing willingness amongst major oil producers to collectively jumpstart the market because of the prolonged price slump. How much credence would you give these reports?
As in, just on those headlines, I find them difficult to digest, in that any sort of cut between OPEC and non-OPEC, given OPEC themselves can't formulate any form of a cut, and any form of a cut within OPEC is going to rest largely on Saudi Arabia. You look at the likes of Libya, where production is down to just 400,000 barrels a day. You look at Iran, where production is set to increase perhaps somewhere between 300,000 and 500,000 barrels a day next year. You look at Iran, which is Iraq, exempt from OPEC quotas, and there's really not much of a case for an OPEC cut. And given what Saudi Arabia have been doing with their commitment to higher production levels, their targeting of market share, even their commitment to investment plans, which is also being followed by other GCC countries, a cut within OPEC seems difficult. So then when you layer in a cut between OPEC and other non-OPEC members, it seems even harder to square. So I wouldn't put too much relevance on those headlines. However, as you saw in the second quarter of this year, and even as you've seen recently in price action, these tend to be picked up by fast money flows, and you can see near-term price support result from that. But all it does is potentially delay a rebalancing of oil market if it helps ease some of the financial difficulties facing producers right now.
All right. Well, we are largely all crude oil buyers, so can you leave us by telling us what is the lowest you see for oil prices in the next 6 months?
Yeah, so I would say the key point is the fundamentals for oil remain bearish, but it's the barrel of crude that comes out of the ground is not the same as the gasoline that you put in your car. So we remain oversupplied on oil right now, likely somewhere in the million barrel a day mark. But right now what it's manifesting itself through is strong crude runs that are outpacing products demand, and so part of that oil supply is coming in the product space, while also in between different crude slates, you're seeing light sweet markets, the likes of Brent and WTI, finding some support, particularly with US shale production slowing down. However, the medium to heavy grades, where production has been strong from the likes of Iraq, Saudi Arabia, and then Iran going forward, are suffering as a result of this. So you have spreads and ARBs correct themselves. So into the end of this year, there is a downside for crude, particularly as US refiners enter maintenance and crude stocks build. However, if we see margins compress, then the first quarter of next year could be where the key downside is for crude markets, given if you have a lower bid from refiners whilst also additional crude supply at a time of relatively high crude stocks, and that's when you can start to see some material weakness in crude prices as a result of time spread softening.
All right, thanks a lot, Chris, for joining us with all those details. So at least in the near term, for the next 6 months, a very bearish view on crude coming from Citi.